Okay, good morning, ladies and gentlemen. In the interest of good old-fashioned British punctuality, going to start the webinar now. We've got the majority of people who have signed up. I can see there are in attendance. If anyone's missing or anyone joins late, they're going to get a recording anyway. So I think it's only fair that we kick things off. I'm just going to share my screen. This is being recorded as well. Okay, so welcome to our webinar. Thank you all for expressing an interest and signing up. We had quite a few late sign-ups this morning. I think people come across it on Facebook and think, I'm not doing anything else this morning. I'll take part in that. So welcome one and all, wherever you are in the world. I assume the majority of people are in Portugal, but I imagine we also have people who are considering making the move to Portugal. So I hope you all find some value in this webinar this morning. So just a bit of an introduction and an overview before we kick things off properly. I have to say that this webinar is for information purposes only. Of course, you can't necessarily rely on it all for advice. If you do need advice, that's what we're here for. And we obviously want you to get in touch with us. Typically, we should be able to do this in under an hour. Should be about 50 minutes presentation and 10 minutes for Q&A. Participants are all on mute. If you want to communicate or interact with us, then you can use the chat box, you can use the question box. We try not to answer questions as we go along because it can obviously interrupt the flow. That's why we have the Q&A at the end. So if you've got any questions, fire them off in the box to us and we'll address them at the end. If it's something more specific, something which may be a bit more involved, then of course just email us and we'll be sure to provide you with an answer. So moving on, what we're going to be covering today in terms of topics, looking quite broadly at financial matters for expats in Portugal, some of the universal challenges of being an expat anywhere in the world, and then as well as those specific to Portugal. And then our experts today who are joining us from Utmost will be talking about how to invest tax efficiently in Portugal. This is a challenge for any expat to be compliant and avoid the problems, but also take advantages of the opportunities that exist. And then as an expat, if you're not using local advice and you need advice as an expat, how can you make sure you're getting the right advice that's well regulated and transparent and that you can trust? And bearing in mind that I think the large proportion of people on this webinar are from the UK. We will be covering UK pensions, not in too much depth because we do actually have another webinar on that topic available on our website. And we don't want to alienate the non-British contingent on this webinar, but we will be touching on that subject as well. And then of course the Q&A at the end. So moving on, just to introduce who we have here today. So this webinar has been put together by myself and Adam. As you can see there, we are partners and advisors in Valiant Wealth. That's our own company, which we started a few years ago. Both Adam and I have been in the industry for getting on to a decade each. And we set up this company a few years ago, brought together our existing client bases, and we have a strong presence across the EU. We are regulated to advise across the EU. We're part of a UK-based group of financial advisors, a network, if you like, and we adhere to UK standards. So we don't get involved in any dodgy practices of taking commissions or selling exotic, hard to understand investments. We adhere to UK standards, meaning that we are 100% transparent, we're fee-based, and importantly, we work for our clients. We don't work for providers. We work for our clients. We're on your side of the table. And there it says as well what we specialize in. So it's long-term financial planning, pensions, savings, investments, tax efficient structuring, tailored and personalized to you wherever you are in the world and whatever your circumstances are. We endeavor to put a lot of content out there and add a lot of value, whether it's through webinars, whether it's through blogs on our website. There's a whole host of content on there. So if you want to know more, have a browse of our website. We really try our best to put out stuff that's topical and relevant and to the point and unbiased. So please visit our website. And as you can see, the sort of principle that we believe in, as we adhere to UK standards, is that your location in the world should not be a barrier to receiving fair, transparent, independent financial advice. Just because you're living outside of the UK, because you're living somewhere like Portugal, doesn't mean you should be vulnerable or taken advantage of, just because things are maybe done differently there. So joining us today, we have Utmost. I'm going to unmute James just to say a couple of words on himself and Utmost. Welcome, James.
Yeah, thank you, Tom. Morning, everybody. Great to be joining Valiant on this webinar here this morning. Yeah, the Utmost group of companies was founded in 2013, and it may be a name that some of you may not have heard before, but if I said the names AXA, Generali, Aviva, Aegon, and others, I'm sure you will be familiar with them. Basically, Utmost is a group of companies that are specialists in the cross-border provision of life assurance. We run over £37 billion worth of assets under administration, working with discretionary managers and fund groups. And really, our presence is both in the UK, Europe, and internationally. And whilst we have a UK head office, and I'm based here in the UK, we do employ nigh on 1,000 people across our business. So, with no further ado, I'm going to introduce Mafalda Cesario, who is our Portuguese specialist and tax lawyer. I'm going to ask Tom to probably unmute Mafalda if he can. There he is. So yeah.
And yeah, I'm here. Hi, good morning, everyone.
Over to you, Mafalda. That's what people are here to listen to, not to me.
Good morning, everyone. So my name is Mafalda. I'm in charge of the Portuguese market. I have a background experience especially in tax, Portuguese taxation on the individual side. I joined Generali, so I'm at Utmost, and I came from the Generali angle. And I'm going to be here today to explain you a bit of how our product Apex, which is designed for the expat market, work from a legal and tax perspective, how the Irish jurisdiction can protect you. So, Tom, if you want to pass the slides. So that you can move to the next one, please. Another one. Okay. So just one back. Sorry, Tom. That's it. So on this slide, what I want to explain you is just a brief introduction of what is a unit-linked insurance policy, how does it work from a legal perspective in Portugal. So in a nutshell, a unit-linked insurance policy, it's a single premium life insurance contract that is invested in a portfolio of assets. This investment in the portfolio of assets will follow the strategy or strategies that were selected by the policyholder. It's also important to understand that the policyholder owns the rights on the policy. Each insurance policy will be linked to a segregated underlying portfolio. The policyholder can surrender partially or totally the policy at any point in time. And the policyholder can also appoint beneficiaries and change them during the time of the policy, of course, if they are not appointed on an irrevocable basis. But if they are appointed on a revocable basis, they can change the beneficiaries during the policy time. Next slide, please. So on this slide, I want to summarize why does Apex work so well for someone moving to Portugal or someone that is already in Portugal? So who is it for? So the product is for someone seeking for a tax efficient and flexible product that meets their changing needs. It also offers potential growth of the funds inside of the policy. It's also a compliant solution, so the product was designed to be compliant from a regulatory and tax perspective in Portugal. And as a consequence, it will offer the tax advantages of the products in Portugal. So Portugal has a special tax regime for life insurance products, which I will get into more detail in terms of the next slides. So as the way the product is designed, it offers that tax efficiency of the Portuguese products. It also offers a wide investment options, so the client has the ability to select external funds or appoint platform advisors or DFMs that will manage their investments. It's also a good solution for succession planning, so it offers a chance of the client to pass the wealth in a tax-efficient manner through the nomination of beneficiaries. So if you appoint beneficiaries, the insurance company, in this case, Utmost, we won't care about inheritance rules. That's not up to us. So this is a way of the client to plan the succession. Another interesting point is that we have a lot of experience in this type of field. So you can also count with a team that has much experience in this type of products and planning to the clients. So next slide, please. On this slide, I'm going now to get into the detail of how does the taxation in Portugal for our product works. So the first thing that is important to understand is that as long as the client does not surrender the product partially or totally, okay, there's no taxation on the capital gains, and the losses that you might have in your portfolio will offset internally within the portfolio. This is a big advantage if we compare with other direct portfolios or with other products you could invest in Portugal, like a simple savings account, because on those ones, you'll be taxed in the moment you have the gain, the dividend, whatever. In this situation, unless you surrender, you don't need to make any type of reports to the tax authorities, and everything happens inside of the policy because the portfolio is wrapped in the policy. In case the client makes a partial surrender, the taxation will happen on the proportional capital gain. So the proportional capital gain will be subject to personal income tax. And then in Portugal, as I was mentioning previously, we have a special treatment from a tax perspective for these gains. So at least if the premiums paid were in the course of the first half of the policy represents 35% of the total premiums, you will benefit of a reduction in the taxation of the gains, depending on the time you have the policy in place. So if the policy's life is between 5 and 8 years, your effective taxation will be 22.4%. But if the policy has more than 8 years, it will be 11.2%. So it's after 8 years of life of the policy that you reach the real tax efficiency in terms of taxation of the gains. And if you compare 28%, which is the standard rate you would be paying on another investment product, with 11.2%, that's a good saving in terms of taxation of the gains. Other important point in terms of taxation of the product is that the premiums are excluded from Portuguese stamp duty and VAT. Also, no VAT is applied on the portfolio management of the custodial fees as insurance companies based in Ireland. And finally, on the death benefit payment, there's no taxation. So there's no stamp duty, there's no gift tax, there's no taxation at all, independently of the relationship between the policyholder and the beneficiaries. So next slide, please. Other advantage of the product is the range of investment options that we offer. So we offer open architecture, platform, and discretionary fund manager. What means all of them? So on open architecture, the clients or the insurance intermediary will instruct Utmost to invest in external funds. In this solution, we have only one custodian. So we have Citibank holding the custody of the assets. On the platform solution, we have the insurance intermediary undertaking trades on the platform, and the platform will be holding the custody of the assets. On the discretionary fund manager, what we call the DFM, so we have the DFM making the asset selection in line with the investment mandate, and the DFM will hold the custody of the assets in this solution. Next slide, please. Now, in terms of succession planning, getting into more detail of what I was referring previously, so I would point I would split between what is good from the Portuguese angle and what is good in case the client returns to the UK. So from the Portuguese angle, the good side in terms of succession planning is that if the policyholder appoints on a revocable or irrevocable basis beneficiaries, this will meet the client succession planning needs. So he can appoint a beneficiary and this person will be receiving the policy value by the time the benefit is paid. Also, the payments to the beneficiaries of insurance policies are out of scope of any type of taxation, again, stamp duty, gift tax, whatever. In case the client decides to return to the UK, the way our product was designed, the revocable beneficiary nomination can be revoked on the return to the UK. No endorsements will be needed for the policy to comply with the UK tax law. And another important feature, in case the client decides to go back to the UK, is that even segments not being recognized in Portugal, we decided to include segments in the policy because in case the client decides to move one day back to the UK, this would allow him to mitigate the tax. And one example is, imagine if the recipient and the policyholder are both in the UK, the policyholder can assign individual segments to the spouse, other child, prior to the surrender. So the product was designed for that since inception. In case the client decides to move back to the UK, everything will work. Next slide, please. And next one, thank you. So, sorry, Tom, one back. On this one, I've just summarized very briefly the product overview. So it's a life policy. It offers also the death benefit payment, which represents 100% of the investment value. On maturity date, there's no maturity date in this product. Life assured can be appointed up to 6. In terms of age limits, so the applicant's age at entry needs to be minimum 8 years and a maximum of 80 years. For the life assured age at entry, it needs to be minimum 14 years if they have the legal guardian consent, and 18 years without consent, and a maximum of 80 years. In terms of life basis, it can be single, multiple lives first death, multiple lives last death. On death benefit is paid to the beneficiaries. Next slide. And another one. Thank you. So what happens in case the client goes back to the UK? So here I'm getting into a bit more detail of what I was explaining previously, that the product is designed for the situation that the client decides going back to the UK. This is what we call portability. So the product, again, was designed to work properly in case the client decides going back to the UK. So for any product to be portable to the UK, it's important to ensure that certain features have been adapted, and that's the case. So one thing that we have created on Apex is a life cover option. In case the client decides to move at a certain point back to the UK, he can select this option when he moves back, and he will have a life cover option. Why? Because in Portugal, you don't need to have it to qualify as an insurance policy. So the product doesn't need to have it since inception. However, we have concluded that it would be important to qualify as an insurance policy in the UK. So this option is in the product, and in case the client moves back, it just needs to select it, and no endorsement will be required for those purposes. Also, the product was designed to ensure that the revocable beneficiary nomination can be revoked when it goes back to the UK. And again, no endorsement will be required. It's already accommodated in the product features. The only thing we would need to endorse, but everything is prepared for that, is the investment options, in order this is all compliant with the UK law and the UK restrictions in terms of investment options. But everything is prepared for that. Next slide, please. On this slide, I just want to highlight what are the investor protection, like the client protection, if we compare the Irish rules and the Luxembourg rules, because we tend to be a lot compared with the Luxembourg insurance companies. And they also speak about a lot in Luxembourg about the triangle of security as something that is a big advantage when you buy a Luxembourg policy. So on this table, I've tried to go through all the main features that usually the clients want to understand and compare Ireland and Luxembourg to explain it that there's really no big advantage comparing Ireland with Luxembourg. So let's start. In terms of solvency regime, both jurisdictions are covered by the EU Solvency II directive. In terms of segregation of the policyholder assets, in both jurisdictions, it needs to be done. So 100% of the policyholder assets need to be segregated by law. So again, the same in both jurisdictions. In terms of governance of custodians, in Ireland, everything is ruled by the Central Bank of Ireland, and it needs to follow the Central Bank of Ireland requirements. And in Luxembourg, you have the three-party agreement. In terms of governing law, here we will start having some differences. So in Ireland, with an Irish insurance company, you will have Irish common law. So in terms of everything there is the regulation part, you will follow common law that UK clients would be more familiar with. And then you also have EU law, because our product was designed to be compliant with the Portuguese law. On the other side of the Luxembourg insurance companies, you will have Luxembourg civil law, and you will have the EU law also. So the Irish one will give you the bits of the advantage of there are some angles that will be covered by the common law, which you are more familiarized with. Now, on the VAT on the DFM fees, that's where you find a good advantage if you compare Ireland with Luxembourg. So in Ireland, the DFM fees don't pay VAT, and in Luxembourg they do. They pay a 17% rate of VAT. On a final one, so if you asked, were there any cases of failure of the life companies in these jurisdictions? So in Ireland, none. And in Luxembourg, there was one case, XL Life. So I would say that in a balance, Ireland offers you a bit more of advantages. Next slide, please. And another one. So finally, oh, sorry, that one. I'm just going to highlight some additional advantages of our product. So it's easy and quick to implement. So it's much easier to set up an insurance policy than a trust or a CCAF. Again, it's also easy to grow because you just need to make additional premiums if you want, and that's it. You just need not to notify us that you want to make a top-up of the policy. Another advantage is, imagine a situation that a client wants to get a loan from a bank and he doesn't want to liquidate his portfolio. He could offer our policy as a collateral to get the loan. So it's what we call the pledge of the policy, and this would be a solution for him to not need to liquidate his portfolio. Finally, it's also very good in terms of simplification of tax reporting, because again, you don't need to report the gains, the dividends that are happening inside of the policy. Everything happens inside of the policy. So only when you surrender, you need to make your reports. And that's it. Thank you so much for your time, and I hope you have enjoyed.
Yeah, thanks for that, Mafalda. It was really, really interesting. I think just to touch on some of the financial challenges which Portuguese residents find. We've dealt with a number of people in Portugal, and there's kind of two aspects which come up. One of them is solved in a way by this type of policy, using this type of insurance wrapper. One of the things that people often find when they move to Portugal, although a lot of those people will be under the NHR regime, which I'm sure most of you know everything about, so I'm not going to go into that. But what people find is that capital gains tax is relatively high in Portugal compared to other jurisdictions, and using this type of insurance structure is a way to mitigate that if you're going to hold it for the long term. So these are quite a useful financial planning device for people. There are a couple of things to be aware of in terms of the standard advice and the type of advice that you might get in Portugal, but I think Tom is going to touch on that a little bit later. The other area that we deal with quite often is in terms of pensions, which I think, Tom, there's the next slide. And although you might think that being under the NHR regime, where if you were subscribed to it a couple of years ago, you would be on a 0% tax rate on your pension income. If you're more recently resident in Portugal, it will be 10% for 10 years. You might think that that's very simple, but there are a couple of traps that people fall into, particularly around transferring UK pensions overseas. And I do apologise for people who are not UK connected, that we are going to focus a little bit on UK pensions. But one of the things that's been very common over the last sort of 10 years or so is people being encouraged to transfer UK pensions into what are known as QROPs, which are qualifying overseas pensions. There isn't really a good reason for doing this unless you've got a lifetime allowance issue. As a Portuguese resident, these have been pushed often on, I would say, invented tax benefits that you might get. But actually, the reality is that a UK SIP can serve just as well. One of the ways in which people are encouraged to use a QROPS is because then they can receive their pension income without any UK withholding tax, which obviously works quite well under the NHR regime. But if you're using certain SIP providers who are accustomed to dealing with non-residents, then they will pay your pension income without deducting UK tax at source from a UK pension. So there's no need to really move out of the regulatory regime of the UK, which is pretty robust, to somewhere like Malta for tax purposes. You just need to make sure that HMRC have communicated your NT tax code to the SIP provider. The kind of fallout from transferring to a QROPS is really the regulatory regime and then the types of assets that can be held within them. And this kind of goes into the quality of advice argument, because it's very much a commission-based industry, the QROPS industry. So they put expensive products within the QROPS, commission-paying investments and so on. And sometimes they can put unregulated investments within those. So there are lots of sort of pitfalls to moving into a QROPS. But if you have a lifetime allowance issue, if you're likely to exceed your lifetime allowance, which is just over £1 million at the moment, then there might be some benefit in using a QROPS as a Portuguese resident, but you want to make sure you set it up in the right way. So it's important that you take good advice on that. As Tom said earlier, we've actually done a webinar on pensions, so we're not going to go into in too much detail. Can you go back to the other slide, Tom, a second, because there are a couple of points that I'll just cover briefly. We've seen people in Portugal ask for advice about UK state pensions. You probably don't need actual financial advice around the UK state pension. The government website is very good. You can check your national insurance record. You can find out exactly when and how much you're going to receive. You can also get free advice around the UK state pension. So you probably don't need to employ a financial advisor to give you any advice, although I have seen people offering that service in Portugal. It's really around if you're going to consolidate UK pensions, if you're going to draw income from UK pensions, that you probably want to take some advice. And that would really be around the structure that you're using, ensuring that you're getting your pension income without UK tax withheld if you're under the NHR regime, and also some currency issues, because there are some pensions where you can also invest, UK pensions where you can invest in other currencies, which can help you manage currency risk. And finally, there is a new problem which has come up post-Brexit, in that a lot of expats are having their UK bank accounts closed, which some of you might have experienced. And a further problem that a lot of SIPP providers won't pay into non-UK bank account. So that's an issue that some people have come across, but there are some SIPP providers that will do it. So if you have any kind of issue like that, then it's worth getting in touch and taking a little bit of advice on that. And finally, final salary pensions, which are becoming more and more difficult to transfer. We don't tend to do a lot of them because often having guaranteed income is actually more beneficial. But we can help with those on a case-by-case basis. If any of you are looking at transfer values, what's happened in recent years is that transfer values have become really inflated, and there's kind of quite a bit of noise around final salary pension transfers, but you do need to be quite careful with those. So on the next slide, there is a link to a webinar that we did. This was quite recent. You can see there it was in April, and we had also with a UK chartered financial planner. So that's quite interesting. If any of you want to go and have a look at that and learn more about pension advice for expats, it is general. It's not Portugal specific because we work with people all over the place, but it's probably worth having a look at. I'll pass on to you, Tom.
Thank you, Adam. Get the video on. Yes, thank you. Yeah, Adam covered everything there on the subject of pensions. I think you can learn a lot yourself on this subject. The UK government website and even the Pension Advisory Service. If you Google those three words, you'll find the website. There's a lot of free information out there. You don't need to get sucked in by an advisor who then just wants to sell you a product. So really, you can go out there and educate yourself. Check out our webinar as well. And we present it all very, very impartially. More often than not, people are very well served by the pensions that they already have. They just need to get the right tax code in place and just get their ducks in a row. Essentially, SIPs are a great solution for people who want to consolidate pensions, manage currency issues, etc. The costs are on par with a UK-based solution. So things have really evolved and caught up there. So there are solutions out there, but in reality, it's for most people, it's not even a problem. And in terms of getting the right advice, as Adam said, we deal with clients all over the world. So whether they're based in the EU, whether they're based in Africa, South America, Asia, wherever, there's kind of universal problems, the language barrier, the cultural barrier. It's true that birds of a feather flock together, and each country has its own sort of culture when it comes to finance and investing and retirement planning. I mean, personally, I actually live in Italy, and here people rely on the state. They don't have private pensions. They don't have really investment portfolios. It's kind of property and an estate pension. The concept of an independent financial advisor is something we take for granted coming from the UK. It's commonplace in countries such as the US, Australia, South Africa, Canada. In other countries, it doesn't really exist. Advice is more one-dimensional. You go to an asset manager, you go to a bank, they sell you the flavour of the month. They're selling products, they're representing the institution that they work for, and they're not necessarily going to give you something bad, but it's not guaranteed to be in your interest. The UK industry is streets ahead in terms of its regulation and transparency, and those are the standards that we adhere to. I mean, James has worked for 20 years, and I think the last 5 years in overseas markets, but before that in the UK, where they cleaned things up probably about a decade ago following the last financial crisis. They had a thing called the Retail Distribution Review. They got rid of the previous regulator, the Financial Services Authority, replaced it with the Financial Conduct Authority, and the focus is on client outcomes. That's the underpinning philosophy and principle of financial advice in the UK. It's client outcomes. So it means transparency, it means fee-based, it means not putting handcuffs on people, not locking people into products, because if the stuff hits the fan, like we saw last year, and you suddenly need to make changes, if you're bound by surrender penalties and exit fees, which are essentially going to reimburse commissions that were paid to the advisor on day one, then you're locked in. All of our solutions, the way we work, it's completely with freedom, and flexibility for the client. So if circumstances change, you can move in and out without any detriment. And clearly the solutions we're, because of the nature of the people that we're working with, who are, let's say, international, you may be in Portugal now, but it may not be your final destination. Maybe you're going to retire back in the UK. So all of our solutions take into consideration this portability factor. And nowadays it's very common that you may have children in other countries. So then inheritance planning is a consideration. You may have property in other countries, you may have pensions in other countries. All of this stuff makes the lifestyle of an expat quite problematic, if you like, compared to just staying in the UK, living and dying on the same street that you grew up on. Who wants that? So it's very nice to be an expat and to live and travel the world, but certain challenges come with it. So the philosophy of our company is to work with people globally and offer them all the same standards. So what you may find in Portugal is a lot of firms who like to promote themselves having golf days, get you drunk on gin and tonic, and then talk you into transferring your pension. Our approach is much more about adding value, doing things like webinars, putting articles out there, putting the content out there, having consultations with people, looking where we can add value, where can we actually solve a problem, and doing what's, putting client prosperity above our own. So if you are in a situation where you're looking for advice, then please get in touch with us for a consultation. Without harping on too much about this, there's certain things to look out for and be aware of if you're an expat, and maybe you get a cold call or someone approaches you, trying to talk to you about your pension or about saving and trying to lock you into products which are unsuitable. So there's just a few bullet points of things to look out for. So always do your due diligence, apply some common sense. If it sounds too good to be true, it probably is. All of that, if someone's desperate for your business, there's probably a good reason that they're desperate for your business, probably because it's more in their interest than yours. So just tread carefully. I think unless there's anything else to add, we can head over to Q&A. We've certainly got plenty of time. I can see all the participants are still with us. So it's, when you do a real life seminar, you can see people yawning or looking at their watches. In a webinar, you don't have that privilege, but so I always go by whether the participants are still on the webinar, and they are. So thank you. So unless there's anything to add, we've got a couple of questions which I'm going to pose to James.
Okay, yeah.
Okay. So we had a question that came in this morning actually from a gentleman who I think is looking to move to Portugal from Southeast Asia. And his question is really about tax residency and when he would become tax resident in Portugal, whether it's from the date he officially lands in Portugal, whether it's from when he buys a property there, whether it's from when he registers as a resident. I mean, as I understand it, the tax calendar in Portugal is January the 1st to December the 31st, not April to April like it is in the UK. And this is a common problem. If you're moving to a country, it's not often that you just pack up everything, get in a plane and go. You may have children still in school, you may be moving, then your wife moves over 6 months later, you may have to move and then sell a property. So it's a common problem. What should people do in this situation, especially I think in this case where he's looking to sell a property in Asia? If he sells it when he's resident in Portugal, he could be worse off tax-wise. So how can people be proactive to best manage this, James?
Yeah, it's always a sort of difficult one to give a straight answer to, because everyone's situation is slightly different. I think the key thing is making sure they have a permanent residential address in Portugal, to make sure they've got somewhere that they're going to stay in. They will also get a tax reference number from the local tax office, which will give them residency. But you've got to make the decision as to when you are moving, because, as you say, different countries have different tax dates, so it's difficult to necessarily give a full answer to that without knowing the individual client's circumstances. But the start process of that is making sure that you have a tax reference number from the local authorities and have a permanent residency in Portugal to have, really.
Yeah, and on the subject of having assets such as a property, is it better to sell those before you move to Portugal, mean, what would be the consequence of selling once you're in Portugal and having to pay potentially capital gains tax on a property overseas?
Sorry, so the client is selling a property in Southeast Asia?
Yeah.
Yeah, so again, that's up to the client what they decide to do. Some people decide to cut their ties with where they're staying, some people don't. We see lots of scenarios where people choose to keep a property in the UK or wherever they've come from. But like all these things, it's about where they're permanently established, and if they're living for more than 183 days out of 365 in Portugal, then they will become Portuguese tax resident. It's based on the number of days you're in the country as well.
I think that sometimes people underestimate the sort of planning time frame you need sometimes to keep yourself tax efficient, because in this case, I guess it's better if he can sell the property before becoming Portuguese resident, assuming he's not going to pay capital gains tax on it where he is. We don't know his location. And there's something else that we've come across actually with a couple of people in Portugal, is that they've moved to Portugal and they're holding products that are based in blacklisted jurisdictions. Portugal has quite an extensive blacklist. I mean, if you Google it, you'll see it. It's quite a long one. There's a punitive tax rate, which I believe is 35%
Right.
on capital gains on assets in those jurisdictions. And we've had people who've moved from Asia, holding Isle of Man products, and then they're in one particular case, we've actually advised the guy just to kind of hold it and not do anything, because he had quite an extensive gain on it. He expects to be in Portugal for 5 or 6 years and doesn't necessarily need the money during that period. But it does put him in a position where he doesn't really want to access it. Whereas if he had, in hindsight, before moving, kind of looked to reorganize himself in a different way, he would have been in a better position, had more access to his money without the fear of a big tax bill. I mean, that's actually another question that I believe we've had about whether you can set up a policy like this before becoming resident in Portugal.
Yeah. So take the first point, you're right. You're best to sell assets that are in punitive jurisdictions prior to completing your move. And I think everybody should prepare when they're moving country. It's not a case of you're here today, gone tomorrow kind of thing. There does need to be some foresight around what assets you hold and where you hold them, because they do have, they are treated differently in different jurisdictions. Sorry, the second question, remind me again, Adam.
It was about if you can actually start, say you've got someone, like this gentleman, imagine that he remains in Southeast Asia, he sells his property, he has a lump sum that he wants to invest in, for efficiently while he's in Portugal. Should he be waiting until he becomes resident, or?
Technically, yes. We can only accept Portuguese tax residents into our product. There are scenarios where, as long as the client's got a permanent address in Portugal and we know that they are Portuguese tax resident within a period and it's all set up, we can start that process, but in reality we can only accept them when they are physically tax resident in Portugal. And we don't want to do things incorrectly, because there's always the risk that the client, something could happen, like a global pandemic, for example. Clients get locked down in Southeast Asia and then they can't move, and then that's a major problem from a reporting perspective. So where possible, we always insist that they are tax resident, and making sure that they've completed their move here to Portugal before they take out one of our policies. But you're right to do the planning beforehand. That's the point I'm trying to make. And I get this request a lot from clients who will say things like, well, I'm planning to move to Portugal. Can I just take out one of these policies and move with it? And for the reasons that Mafalda outlined earlier about the specific beneficiary clauses and the specific legislation that surrounds a Portuguese compliant product, it's important to make sure you receive advice in the jurisdiction that you're going to arrive in, rather than to do that beforehand.
And on the subject of tax residency, does Portugal look at it in a very black and white way of how many days you spend, or is there room for grey areas? Because if, you know, for example, it's 2021, it's already June. If somebody's moving over this month, but they still have their kids in school in another country, they've still got property there, their centre of life may not be Portugal for this year, even if they do spend more than 183 days. So they may pay tax in another country for this calendar year and then be officially tax resident in Portugal as of next year. Is it more black and white than that, or is there room for grey areas?
I'm hoping Mafalda might be able to just assist me on this one by answering this one.
I will. So on that one, besides the legal part, to be honest with you, the way things work here, you have the number of days. It counts the first day you are considered resident. You have the 183 days, as James was saying, but you also have another rule. It's not quite recent, but it is not as old as the 183 days, which is you are considered resident in the first day you are resident in Portugal, if you are here for more than 12 months, if my memory is not killing me. But the thing is, from a practical perspective, the way it works is the tax authorities will look in the system to the date you say them that you are resident here. And how does it work? So you go to the tax authorities, even asking for your tax number. Initially, you always ask, that's the usual procedure. You ask tax number as non-residents, but once you have, for example, a rent contract here with an apartment or a purchase deal that you bought a house here, you can prove them that you intend to stay here as resident. With these documents, they will change your tax number to resident. The number is exactly the same. The tax number is always exactly the same. It doesn't change. The way you can check if for the tax authorities you're resident or non-resident is you need to log on the system. Okay, everyone has a password and a username, and you can see if your address in your personal information is in Portugal or everywhere else outside Portugal. Okay, if it has an address in Portugal, it means that for the tax authorities, you are considered tax resident, and you will see the date there since which you are considered tax resident here. So from a real practical perspective, that's how the tax authorities consider you resident or non-resident, is depending on the information they have in the system. And you have some power in the way you manage this with the tax authorities, because you are the one going there and providing the information that allows them to understand if you're resident or not. Of course, legally speaking, if there's an inspection from the tax authorities and they realize you were here previously, let's say you only provide information to the tax authority saying you changed to be resident on August 2021, but in reality you are here for more than 2 years, they will say that you should have been paying taxes as resident for that period also. But how can they find it? That's the point, you know, because everything here is made on the sense that it's the individual asking the tax authorities, please consider me resident because I have this and this that makes me resident, okay? So I would say you would need to look at the legal angle, but have into account that everything is really practical in the way it's seen by the tax authorities. They really look to the system, to the information they have in the system, and it's up to you to provide that information.
Thank you. I think all this highlights the need to engage with an expert.
Absolutely, and Thomas, just to highlight, so I used to work as a independent legal counsel, a taxman in the past, and the things you see from the clients when they arrive here and they didn't got the proper planning before they move here, it really messes up people's life from a tax perspective. If you can start planning in advance, it saves you a lot of money and a lot of complications, headaches, because imagine the situation you were describing of selling a property when you are already here. You can face double taxation because the country where you have the property might want to tax it because the property is there. Then Portugal works on the worldwide taxation. So whatever is your income, Portugal wants to tax it. Of course, we have double tax treaties, but it's such a long way compared with planning everything in advance, and it really can save you money and headaches.
Mafalda, on that point, I'd heard about a tax exemption for people who sell their main residence who are over 65. You're aware of, I mean, I don't want to put you on the spot, but I don't have a clear understanding of that. But I wonder if someone in this sort of situation, it might work, or if that is only for Portuguese property.
No, well, that's a good one. In principle, it should be Portuguese property. Why? Because the tax, first, in order you can benefit of that regime, the property you're selling needs to be your main home, okay? And the only way the tax authorities will be able, once they are checking if you can benefit of that, they need to go to the system, again, the system, and check if that property was your main home. How do they do it? Again, they will go to the, first, you get the benefit by asking it on your annual tax return, okay? So in terms of system, the way it will work is the tax authorities will check if the property you're selling, you sold, used to be your address in the tax system, okay? So the only way they have to check this if it is a property in Portugal, okay? And not sure if I answered all the questions, but if the next question in here is that if the client can reinvest the proceeds of the sale of a main home in Portugal in a product like ours, for example, that's a very good question. Okay, so let's go step by step. You need to follow verify some conditions to benefit of this regime of the reinvestment. Okay, it's quite recent. So we are not aware of any inspections made by the tax authorities that provide us some clarity in terms of exactly what products could benefit of this. They mention life products in the law, okay? The client needs to be over 65, you're right on that one. There's a minimum period to make the reinvestment, and the client needs to take an annual amount that doesn't exceed 7.5% of the amount invested in a policy. Now, what's the issue here? If you look, I'm going to be very practical here. If you look to a product like ours, it's not specifically designed as any life insurance product to pay you regular amounts, okay, by default, okay? But it's possible, and the product allows that since inception, you ask us to put in place regular withdrawals, okay? And you could manage that in the sense of not exceeding the limit that's allowed the law establishes. But we are not sure if the tax authorities will agree with us that if you set up the regular withdrawals, it still benefits of this tax regime. We know that some insurance companies already ask for a ruling from the tax authorities, okay? And as the rulings here in Portugal are public, there's no point in everyone asking the same question. But I can tell you they asked more than 1 year ago, and they are still waiting for the tax authorities' reply. So my advice here is always, we believe we have arguments that our product would work if the client set up since inception this regular withdrawals with a maximum limit of 7.5%. But we can never guarantee because there's no answer in terms of ruling from the tax authorities, and we don't know if they are expecting a kind of an annuity product only to allow this benefit. It's very poorly written. That's why anyone has confidence in saying black and white what products really can benefit. But we are seeing more and more insurance companies advising that if everything is set up since inception, we believe that our arguments can work. But from my view, we always need to be clear with the client and caveat properly, like we really cannot guarantee, we think it works, but if you have an inspection, again, there's no certainty here.
Yeah, interesting.
Yeah.
So it just sounds like it hasn't been very well defined from the outset.
Yes. Another advantage, Adam, that might be interesting is imagine someone is selling a property here, the main home again, and he doesn't want to reinvest the full amount in a product. He could reinvest the remaining amount from the proceeds in another home. Okay, you can split the reinvestment between another main home and a product. The reinvestment benefit in a main home is defined in the personal income tax code for years. So that one exists for years. This is a kind of a new one, and the client can split between the two if he wants.
Okay, so he can get the tax benefit on part of the money as well.
Yes, exactly.
Yeah, it's an interesting bit of legislation, if it could be clear.
Properly used, yeah, yeah.
Okay.
Okay, there are just a couple of questions in the box which I think you can read. I mean, can't give specific tax advice to individuals, obviously, on a webinar, but broadly speaking, I think the panelists can all read the questions as well. So someone who's living in Portugal, renting out a property in London, for example, would they pay tax on that in the UK, pay tax on it on the rental income in Portugal? What does the DTA cover?
Well,
we don't know where they're tax resident or where they'll be tax resident, so that comes into it. But they will have to pay tax on the income they receive from a rental. Where they pay that is dependent upon where they're tax resident. So
rental income's in the UK is taxed at source. So I assume it will come under the double taxation treaty.
Yes. So again, sorry, if they are tax resident in Portugal and they have a house rented in the UK, as Portugal taxes the residents on their worldwide income, Portugal will want to tax it. So we would need to look to the double tax treaty between Portugal and the UK and see how the double taxation is mitigated there. And the way it would work is on the tax return, on the annual tax return, the client will report on Annex G, which is the annex of the foreign income, the rental income in the UK, the tax he paid in the UK, and Portugal will give the tax credits. But the way the tax credit is calculated, we would need to check the double tax treaty.
Yeah. Okay. Only a couple more questions. There's one here, someone asking about capital gains tax on shares, ETFs, investment funds. I mean, capital gains tax generally is applied when an asset is disposed of, when the gain is realised. That's sort of a universally true thing there. I can get in touch with that person directly because I think they've actually left the webinar now. And then final question, if you can, one of you can read that as well and answer that. From South Africa. I mean, they probably need specific advice.
Is the NIF the tax number that you mentioned?
Exactly. Yes. Yeah. It's the NIF. Yeah.
I think on that question before, in Portugal, if he's talking about Portugal, it's 28% capital gains tax normally, isn't it?
Correct. Yes. Correct.
as long as they're held in a non-blacklisted jurisdiction.
Yeah. Yeah. Exactly.
Which then is 35. Yeah.
So the way that you can, you know, the type of insurance structure that Mafalda explained can help with that. By if you're going to hold the assets for more than 5 years, then the rate starts to reduce. While we're on that, just one question, Mafalda, which might be of interest to them. I mean, what happens if you hold the product has a tax benefit that starts after 5 years? If you make a partial withdrawal in, say, year 3, do you get any tax benefit? Do you get a partial benefit at all, or it's just standard tax rate?
It depends if you keep or not. So first, if you surrender after 3 years, you will be taxed at 28 on the gain, okay? Then on the question, if you surrender, let's say, after 8 years of the policy again, if you get the tax benefit or not, it depends on that initial condition I mentioned, that the investment of the premium by the time you represent needs to be at least, I think it's 35% of the initial premium. So you need to make those calculations to understand if you can still get any tax advantage or not. It's always a balance. One thing that maybe it's important here for me to clarify is The 11.2% effective rate I was mentioning after the 8 years of the policy, if you Google, that rate doesn't exist, okay? It's an effective rate. So the way it works is the rate is still 28%, okay? Even if you have the policy for more than 5 and between 8 years and more than 8 years, what happens is the base, the gain you are reporting, it's going to be reduced. And that reduction is what makes the effective rate being 11.2%, okay? So just to avoid that if people start Googling the rate, it doesn't exist. But if you make the calculations with the reductions that the law mentions, you will get an effective rate of 11.2.
Okay, brilliant, thanks.
Okay, I mean, there's one more question on here, but I think it's quite a personal one, so we should probably maybe answer that person directly. It's brought us up to an hour, so unless there's any final words, I think we can wrap things up. Anything else to add?
No, I don't think so.
No? Okay, well, just to say thank you again, thanks everybody for attending. We're sending out the recording later on today, just a chance to edit it and whatever. Again, if you want to get in touch with us, please feel free to do so. Visit our website and find all the material, relevant content on there, and keep an eye out for future webinars. We want to do more of these, become more familiar with working with expats in Portugal. So please keep an eye out for us and future events. So thank you, James. Thank you, Mafalda, for your extra
Thank you.
time today.
Thank you so much.
Yeah, thanks everyone. Goodbye.
Bye.
Bye bye.